Ian, you basically work with your clientele in the stock market.
Right.
Okay. Again, I mean, at the risk of beating a dead horse, so to speak, I really think that precious metal stocks are the place to be. Comments?
Well, we've been there really since 2000. We've been particularly in the junior sector, because that's where we like the leverage, and our returns have by being in that area have been extremely good. I mean, we really pick management.
Yeah.
When you're buying a junior, and we've already done very, very well. But the thing is that this is just beginning.
I was going to say, yeah, I think just beginning.
The crash in the stock market, because they basically held it from crashing. In 2000, when the Dow dropped from 11,750 down to 7,200, they basically put interest rates down to 1%. They flooded the banking system and to rejig the thing. But really, that was the beginning of the contractive winter, that initial downswing. The Nasdaq has never recovered, 50 to 50% of its losses. So when this thing really starts to take hold, you will see a run to gold like it was. It's hard to imagine, but imagine back to 1982. The Dow was at 777, August the 12th, 1982. And Robert Prechter had sort of said the Dow was going to go to 3,600, and people scoffed at him because we'd never really been above 1,000 on the Dow. The 1,000 was a sort of the point of resistance. And here was a guy calling for 36. Well, we went through 36 like a knife through butter.
Yeah.
We went to 11,750 and now 12,600.
Yeah.
So when this crash comes, and I think it's coming this year, because and Roger and I were talking about it, all the cycles are aligned this year. You've got the 100-year cycle, the 20-year cycle, which is anniversary of the 87 crash, the 100-year cycle, 1907 crash, the 10-year cycle, the long-term capital management. Everything is aligned this year to sort of forecast a crash in the equity markets. And when that happens, the run to gold is going to be huge. Paper and gold always work opposite to each other.
Sure, right.
In big bull markets, 82, 2000, gold didn't work. It went from 850 to 250. It was in a bear market. Stocks were in a bull market. In the 70s, stocks were in a bear market from 1966 to 1980. Gold went from 35 to 850. So they always work opposite to each other.
Yeah,
Sure.
and I would like to just add that the sentiment, if I walk down the streets of New York, I dare say I wouldn't find 1 in 1,000 who were bullish on gold. When Ian,
No, you wouldn't. That's right.
What happens, what Ian's talking about, is what will drive all of those people to gold, and then your gold price is going to be unimaginably high. Who's buying gold now, I think, are central banks, wealthy investors, wealthy people around the world. The common average folks, and even large wealthy people, are not buying gold in the United States at all yet. But they will when they lose confidence in the dollar, and that's what's going to happen, or the financial system, and that's what's going to happen when what Ian talks about comes true.
This whole thing is so distorted, too, by the fact that a lot of these numbers we're tossing around are measured in dollars. The Dow being at 12.5, what is that really?
Well, exactly right, because what we should become accustomed to doing is measuring everything in terms of an ounce of gold, or grams of gold. Because my house, when I sold it a couple of years ago for $450,000, would get $750 on the market now. That house is worth not a penny more; it's worth less because it's had wear and tear since then.
Sure, right.
It's only the amount of money they've pumped into the system. Everything you've got around here, everything you look at, Vancouver real estate, for example, right here in the city, everything you look at, copper prices at $2.50 was up to $4. All those things are rising not because they're worth any more. Well, maybe there's some shifts in demand, aggregate demand, because of the Chinese phenomenon and all that. But ultimately, it's based on the number. We're debasing our currency. There's more units of measure. I like to say it's a little bit like looking at a yardstick, and if you took an inch off the yardstick every year, it would start to take more yardsticks to measure the same length as you measured before.
Sure.
And that's what they're doing with the currency.
Yep. Paul, I think we have to wrap it up. I think we're out of time, if I'm not mistaken. But I've got to say it's been a very, very interesting discussion.
We've been talking with Ian Gordon with the Boulder Investment Partners. and also well known by most of our listeners and viewers for your long wave analysis. Jay Taylor of Jay Taylor's Gold and Technology Stocks, and now Jay Taylor's Energy and Energy Tech Stocks. Did I get it right?
You got it right, Paul.
Okay, and Roger Wiegand of Trader Tracks, and we appreciate you guys very much for being here. We'll have links to your websites from ours. We appreciate everybody for joining us from the 2007 Vancouver Resource Investment Conference.